One of the biggest questions investors have when it comes to stocks is figuring out what they're worth. Essentially, how do you know what price to pay for shares of Costco or Microsoft or for Starbucks to ensure you're getting a good value? And there are many ways to figure this out, but one of the most popular methods for sure is to look at the price to earnings or the PE ratio, which is fine. But at the end of the day, especially for dividend investors, it's really all about the free cash flow. Now, free cash flow is particularly important for dividend investors because the dividend is paid out from a company's free cash flow. Because of that, we definitely want to see a positive and ideally a growing free cash flow number. With that in mind, aside from the PE ratio, another way to value a stock is to look at how much free cash flow is being generated relative to the value of the company. This is what's known as the free cash flow yield, and I think it's a better valuation method for dividend investors than the PE ratio. Plus, it's extremely easy to use. Now, I first learned about the free cash flow yield from reading this book right here, which is Investing for Growth by Terry Smith. And in case you've never heard of Terry Smith, he's the founder of an investment management company called Fundsmith, and he's been referred to as the British Warren Buffett. In the book, Smith talks quite a bit about the free cash flow yield and about how it's his preferred method of valuing stocks. And to explain it, he writes, "We seek to buy our portfolio companies when their free cash flow yield, which is the free cash flow they generate divided by their market value, is at or above the yield we would expect to get on long-term government bonds in the same currency." He says, please note, not the current yield on bonds, which in most cases has been depressed by governments buying their own bonds, but the yield we think might apply if this were to stop and all bonds had to be sold to third-party investors. Our starting guess for the yield that might then be required is 1% over the expected rate of inflation. If we can buy shares with free cash flow yields higher than that, and which will grow, unlike the coupon on bonds, we should have captured some value. So put more simply than the quote, they seek to buy companies when the free cash flow yield is at least 1% above the expected rate of inflation. This reflects the notion that investors typically demand a premium above inflation to compensate for risk and to ensure there's a real return on their investment that surpasses the rate of inflation. If they can purchase shares of companies who have free cash flow yields higher than the estimated rate of inflation, and those companies are expected to continue growing over time, then this strategy suggests that some value can be created from the investment. Now, question one with all of this is, how do I know where this threshold is? Like, where do I go to find the expected rate of inflation? And that's super easy. If you just Google expected rate of inflation, in the search results, you'll see a link to the Federal Reserve Bank of Cleveland website right here. If you just click that, it will take you to this page where it shows you the 10-year expected rate of inflation, which as we can see right here is 2.36% at the time of recording. So with that, if you add a 1% risk premium on top of that number, then you should be looking to invest in companies who have free cash flow yields at least 3.36% or higher based on Terry Smith's approach. But then this brings us to the next question. So how do you find a company's free cash flow yield? And that's also super easy. So if you look up a stock on Seeking Alpha, like for example, we'll take a look at Costco here, it'll bring you to this summary page, and to find the free cash flow yield, it's super easy. You just go over to the dividends tab from here, then you go over to the dividend yield tab right there, and it'll bring you to this page. And if you just scroll down all the way to the bottom, you will see the free cash flow yield right there. And we can see that for Costco in the trailing 12 months, the free cash flow yield is 1.97%, which is obviously quite a bit below that 3.36% we were looking for. So just based on this free cash flow yield, we would look at that and say that Costco is probably a bit overvalued. Now, taking a look at another example, we'll see what's going on with Apple here. So we're over here on the dividend yield page. Let's scroll down, looking at the free cash flow yield. We can see that for Apple, it's at 2.88% in the trailing 12 months, which once again is below that 3.36% we're looking for. So just like with Costco, we would look at this and consider Apple to be a bit overvalued as well. But anyway, guys, let's take a look at one more example just for fun. Let's see what's going on with Nvidia. So if we scroll down looking at the free cash flow yield for this company, it is the lowest one we've seen so far at 1.25%. So based on the free cash flow yields, all three of these companies would be considered overvalued. And although they're all quality companies, no doubt about that, we may not want to buy them at current prices based on this valuation method. With that though, we can still use the free cash flow yield formula to calculate a suitable price to buy these companies at based on the free cash flow yields that we're looking for. So if we're looking for a free cash flow yield of 3.36%, all we need to do is divide the company's free cash flow per share by the free cash flow yield, and that will tell us the share price we should be looking for. And this is what those numbers look like for the companies we just talked about. So starting here at the top with Costco, based on a 3.36% free cash flow yield, if we wanted to buy this company at that free cash flow yield, we'd want to buy Costco at around $464 per share, which based on its current share price means it is just way, way overvalued, okay, to the tune of about 82.4%. So we may want to wait for cheaper prices with Costco if we're using this valuation method. But anyway, moving on to the second company, Apple, it's a pretty similar story based on the same free cash flow yield. We'd want to buy Apple at around $182 per share, which means that it's still about 25% overvalued. And then last but not least here, guys, Nvidia, I mean, this is pretty insane. I mean, as you guys know, Nvidia's seen just a crazy run up in share price over these last couple of years. And based on our desired free cash flow yield, we may want to consider buying Nvidia at around $44 per share, which means that at current prices, it's almost 190% overvalued. That's just crazy. So there's still a ways to go for these companies before they start to look attractive again. But now on the other hand, let's take a look at some examples of companies with extremely high free cash flow yields. And these are going to be the companies in my own portfolio that have the highest free cash flow yields. The first one that we're going to look at here, guys, is Snap-on. And if we scroll down, taking a look at this company's free cash flow yield, it is sitting nice and high at 7.83% for the trailing 12 months. And based on Snap-on's share price performance here in 2024, it's not surprising to see the free cash flow yield on the higher end. I mean, as we can see year to date, it is down 7.25%. And so as the company's share price goes down, similar to the dividend yield, the free cash flow yield is also going to be pushed up. But anyway, guys, moving on to the second company, this one is going to be Altria Group. And Altria is a free cash flow generating machine. So it's not going to be surprising to see it have the free cash flow yield that it does. We can see in the trailing 12 months, it's at 12.85%, which is pretty crazy. And then the third stock, guys, that we'll look at is KRC. If we scroll down, KRC doesn't have a listed free cash flow yield because it's a real estate investment trust. So we're going to be looking at the FFO yield, which is going to be the REIT equivalent of the free cash flow yield, but it still works the same. And for KRC, the FFO yield is at 13.16% in the trailing 12 months. And judging from the share price performance, once again, it's not surprising to see the free cash flow yield on the higher end because this company really has come down quite a bit in share price. I mean, just year to date, it's down 11.4%. Now, having said all of that, because the free cash flow yield is so high for all of these companies, does that necessarily mean that they're automatic buys? No, I mean, just because they look cheap based on this one valuation metric, that doesn't mean that you should invest in them. The free cash flow yield is just one of many things that you can look at when doing your due diligence on a potential investment. And I think it'd be a mistake to invest in a company based on this one metric alone, or for that matter, for any one individual metric alone. I think that'd be a mistake. And speaking of mistakes, in this next video right over here, I'm telling you about 7 more painful ones that you'll make as a dividend investor. I've had to learn a lot of these the hard way, and hopefully by watching this video, you can learn from my mistakes. So click right over here to check these out, and I'll see you in the next one.